Good afternoon, everybody. It is June 9th, 2022, and the market tumbled a bit today, which is what we've been talking about to expect for months and months and months. And many people remember the days when QE just always meant buy the dip, and now QE for the last week has gone away. The Federal Reserve has started to unwind their balance sheet, and for folks who haven't wrapped their head around that yet, I believe that the pain is only just beginning, because most people are large cap investors, and large cap investors tend to believe that the companies that they own are immune from a rough market, and that the Federal Reserve will always come to the rescue. I don't believe that's true. In fact, I believe that we are entering an age where quantitative easing will be more targeted and more judicious and a lot less friendly to the zombies. There are, in the S&P 500, as many as 200 companies that are high debt and low growth or no growth, or in fact already shrinking. That's a very bad combination. We know that about 1/3 of the companies in the S&P 500 over a 20 to 30 year period will fall out of the S&P 500. That's the historical thing that has happened. I believe that it's going to accelerate, that by around the end of the decade, you're going to see about a third, maybe a little bit more, of the companies in the S&P 500 no longer in the S&P 500. I believe that what we're entering is another long-term period of outperformance of the small and mid caps. Mid caps, of course, pretty much always outperform, which is why that is the sweetest spot in the market. The best mix of risk and reward can be found in those companies that are getting close to being on the S&P 500. The biggest gains, of course, can be found in finding the companies one step smaller than that. Companies that are about to become mid caps and then become large caps. So this week I covered something because I basically was asked to. I had a subscriber say, hey, I'm really concerned that we're missing it in energy. And I always know that means that we're near the top of a particular rally when people who have no business chasing a rally start to ask, should I be chasing this rally? So I wrote an article about safer energy dividends for tomorrow, and it's gotten a little bit of reading here on Seeking Alpha. And what I can tell you is that the future of energy is so much different than the past. And if you can't quite wrap your head around that, I would ask you to get in your car, drive backwards down your driveway, maybe around a parking lot. I wouldn't want you to do it in a road, but drive backwards. I don't mean go the wrong way on the road. I mean drive backwards. Their head looking behind you. You be the one that's backwards. Have the car keep going forwards. And see how well you do staying between the lines and avoiding an accident. Put your right arm behind the headrest of the passenger side and look over your shoulder and then drive forward. Because folks who are asking about getting into oil stocks now, that's exactly what they're doing. They're looking in the rearview mirror. They have their face pressed up so close to that glass that they can't see what's in front of them anymore. It's kind of like with the shoe shine boy or the Uber driver nowadays, or the old joke was the shoe shine boy gave me a stock tip. Today it's the Uber driver telling you what stocks to buy. And unfortunately, with the internet, a lot of those people are published. So is there a puff left on the cigar for oil stocks? Oh, sure. There's always a puff left until there's not. Federal Reserve is looking to reduce demand across the board to bring down inflation. And they're trying to do it without hurting supply. That's going to be a tough trick. The federal government is going to have to make sure that supply chains continue to move back to America and get to a spot where supply is reliable again, especially for semiconductors and in the long term for food. And when we take a look at all the moving parts in inflation, what we realize that the only really big thing that's going to be hard to deal with in the next couple of years, just because it takes time to fix this problem, is that the price of oil and gas is going to be hard to come down quickly. Kirk, weren't you just saying that I probably don't want to buy oil stocks? Yeah, I am, because the oil stocks have run so far ahead that as soon as the price of oil finally spikes, and Studer thinks it's going to get up towards close to 200 for a hot minute, and that makes sense to me. Remember a couple of years ago, I said the price of oil would get down to $30 or $40 a barrel, and this one was like 60, 70, 80. Everybody said I was nuts. Turns out I was, because it went to zero. Now people are saying, hey, price of oil is going to start drifting down. Well, it's not really how it works. It's not usually smooth. You get spikes and crashes. We're somewhere in the middle of the spike. And if Saudi Arabia really wants to cause trouble, they can. And Russia has kind of put us in a position where it's almost impossible for supply to keep up with demand unless demand falls. Don't you understand what I just said there? Unless demand falls, we're going to have a shortage of oil and gas, at least for maybe a year. Could be two. But usually demand falls when prices get too high. I've been tracking travel numbers, and we monitor a lot of things in travel because we like to do that. And I can tell you, as high as the price of air travel got in the last few months, it's starting to fall again. And why do you think that is? It's because demand is starting to fall. People aren't planning a ton of trips past Labor Day, which makes me think I'm going to buy those airline tickets to Paris that I can get for under $500 round trip right now if I go in the fall. So when you take a look at inflation and energy and markets and all the big moving parts, you have to ask yourself a question. Do you think the Fed is suddenly next month going to stop raising interest rates and stop with quantitative easing? If we know that supply of oil is only going to go up 1 million or 2 million barrels a day over the next couple of years, we have to somehow keep demand from screaming up because everybody feels new rich. I just read something. It was between 4 and 5 million people working age, mostly millennials, who think, I have enough money, I don't need to work right now. There's always going to be jobs out there for me. I made so much money in Bitcoin or trading my account that I don't have to go get a job. And I'm just starting to run into people starting to wonder if that's true anymore. Remember last year I went to a fantasy baseball draft, 2021, over a year ago now, and I told you how 2 of the guys in the room suddenly said, oh, I'm a chartist now. I just stay home and trade. I don't have a job right now. I'm making like over $1,000 a week trading. I was like, wow, how big is your portfolio? Oh, it's like $37,000. And I was like, what? You're making $1,000 a week trading? Yeah. And it was because everything just went up when the Federal Reserve printed money. And I told you that some of the new traders were going to learn how to short the market. The other ones would get washed out because they just took for granted that they were brilliant and never crossed their mind that the monkeys were making money too. So I've been looking at some charts, trying to think this through. Remember a few weeks ago I said, I'm worried that the elevator doors open and there's no elevator there and everybody rushes in anyway. I'm looking at some anomalies on these charts, and I'm telling you that the Armageddon zombie apocalypse is getting more likely, not less. That an elevator drop in stocks is getting more likely, not less. If the Fed doesn't protect you and panic takes hold of this market, and I already can see it with the old men that they've been selling, if the indexers start to sell, holy cow, is it going to get rough. And it's going to be fast. It's going to be destructive. I'm not really sure at what point that stops. But I can tell you that when you hear people say, oh, there's $2 trillion on the sidelines, it's not that big of a deal because there's always $1 trillion on the sidelines. So the excess money on the sidelines is about $1 trillion. That's big. We have to realize that virtually all of it, like 850 billion or 900 billion of it, is controlled by who? Who controls the lion's share of the excess money just sitting in banks, the idle money? Who controls that? Who controls hundreds and hundreds of billions of dollars? Do we all share that? Is it the middle class? Is it the poor? No, it's the super rich. It's the very, very big investors. It's the family offices, which I keep talking about. And it's the institutional investors. And it's the big institutional private investors. It's not your mutual funds. It's not your hedge funds. Your hedge funds trade. The big money on the sidelines is controlled by the super duper wealthy, whether it's through their family office or an institution that caters to them. That's about 70% of all money and assets in general. But of the cash on the sideline, it's the super wealthies. So when I show you my quantitative studies, and I show you those volume studies on the left-hand sides of the charts, and we see where demand really lines up, you really ought to be scared. Somebody asks, what would prompt the indexes to sell? I just told you. In a downward moving market, which we're in, at some point people start to panic. And I've told you the 2 groups that panic. It's the old men and the passive investors. The old men panic for a whole host of psychological reasons, right? And there's natural studies on this. The old men sell first, and they panic first. They have obligations. They have people to protect, and they panic. And then they get frustrated. They blame other people. They bring people down in their panic. The people they bring down in their panic sometimes are their kids, their neighbors, guy at the bar, who then start to sell the funds in their retirement plans, which is what's left of retail money. And if that happens, and some of the millennials and other people who have learned how to short the market and trade options start to bet on the downward momentum, the same way they bet on the upward momentum by buying calls, what happens, right? Because we understand how options work too. What happens if they keep buying puts? That forces the market down the same way buying calls forces the market up. And until there's exhaustion in selling, it just keeps going down. We are at a pretty significant support zone I identified for you. If we don't bounce off of this, you're going to see this jitterbug and drop. Here's something that I find very scary. The reason I have this chart up, I just wanted to show you how this looked going all the way back to 1994. Why this area here, for 20 years, look where the top was, 2012, same as in 2007, and just a shade above 2000. Why did the stock market quadruple in the last decade? Was the economy that much better? What is the one major thing that changed? Quantitative easing. So when people with magic charts tell you, well, my experience is that this cycle and this wave and this thing just keeps doing this, they're not looking back far enough. You have complete and utter regime changes in the monetary system. And while I am no apologist for the Fed, I will say the big thing that people miss over and over and over again is that the Fed has been compensating for bad government and negative aging demographics. Well, the aging demographics are starting to smooth out. We're at the very front end of that. It's going to take 20 to 40 years. And this normalization that they're trying to push, it's going to take time. It's going to come in phases. But the economy is so strong right now that when they take a look at what's going on, they say, and they actually say it out loud to you, what I'm about to say, you can go find Fed presidents that are saying the same thing. They're saying, we think that we can engineer, right? Engineer, which means control. We can engineer a soft landing in the economy. We can bring down demand without hurting supply. That's a tall order, my friends. That is a tall order. And if OPEC doesn't cooperate with pumping more oil, we don't go to Canada and say, yeah, give us those 900,000 barrels of oil a day that you said that we could have. Still going to take 2 years to get it because you have 3 different phases of how it gets here. Trucks, reversing pipelines, and then the new pipeline. That's what it's going to take to get more Canadian oil here. That'll probably be a way that we refill the strategic petroleum reserve, actually. That with a little bit of oil from Venezuela someday, unless they can avoid it. I mean, maybe they think they don't need Venezuela. And there's, like I've told you before, some merit of truth that they don't want to bring down oil prices too far because they want to incentivize people not to buy more ICE vehicles. So what happens if inflation stays a little higher? And the Fed's like, look, if we're not going to do anything to lower the price of oil very much, if we're just going to try to get it under 100, but not all the way down to 60, how do we lower demand to get inflation down to 2 or 3%, right? They got to tighten, at least through the summer. And now they're talking about tightening, like really executing the tightening that they talked about come September. Now, I still don't know that I believe it. I think that we're going to get this correction really fast. It's going to be really scary. Maybe the Saudi Arabians play ball a little bit. The thing is that there's so many moving parts that you don't know. And anybody that tells you that they know is a goddamn liar because nobody knows what the Saudi Arabians are going to do. Nobody knows how motivated the governments of the world are to get us off of oil. Expensive oil really discourages you from buying more, doesn't it? So for the next 3 months, I am super cautious because if we get a rebound, that's just more reason to sell. And if the divergences in these charts are as scary as I think they are, we're going to get panic. And we're going to get angst going into a political season. I already see the commercials in Wisconsin. I know they're in other places too. Some of the ridiculously dishonest things that are getting talked about with inflation, and people buy into it because of their proclivities ideologically and just their near-term viewpoints, what's in their face right now. And I just spent an extra $35 buying gasoline. So it must be the goddamn idiot's fault in the White House. Even though I've been talking about these problems coming for 4 years. This transition away from fossil fuels is going to be painful because we aren't forward-looking enough. And it's too late to be. because we should have been doing things for the last 10 years and we just tip of the iceberg stuff. We should be so much further along in getting off of oil, but we're just stubborn. It was cheap. Why should we have done that? The tornado, the storm, the hurricane, the typhoon didn't wipe me out. The wildfire didn't get me. The drought didn't make me hungry or thirsty. Why can't I have my oil? These things are really tied together so much more than people give credit for. When you translate it to the market, this should scare the hell out of you because this wasn't natural in the first place. This really wasn't natural either. This chopping along was pretty natural. And then it jumped up, COVID, and then zoomed to the moon on extra QE, on QE infinity. Jeremy Grantham is saying we get way down here towards 200 on SPY. And another analyst just came on TV today, another guy who's, made millions and hundreds of millions of dollars investing. So he's got some street cred. He said, yeah, my base case is still just for the S&P 500 to get into the lower 3,000s, which is right where I've been. But the possibility of heading all the way down to the low 2,000s is opening up right now. And what could take us from a run-of-the-mill bear market to a zombie apocalypse is inflation staying sticky, the Fed staying aggressive, and people panicking into the face of tightening wallets and very heavy rhetoric. That's what could do it. And if it moves to the downside, if we get this elevator drop, it won't be wavy. At best, it'll be like getting thrown down an escalator, but it could be very straight down. In 3 months, you could see this stock market drop 40, 50%. Not saying it'll happen. What I'm saying is that the risk of it happening is very high relative to most other times. So you take a look at the S&P 500's relative strength index, and you say, hey, Kirk, on a monthly, it's oversold. And normally that's a time to buy. Then you take a look at the money flow and say, hey, it's a divergence. It started to go up. So the money flow started to go up, and the RSI hasn't followed it yet. So one of two things should happen here. Either, this is the normal thing that would happen, relative strength index and price would start following the money flow up. What if this is just the rally that I talked about, and money flow has one more big leg down, all the panic selling? We haven't seen panic selling. What if it's not different this time, and there is panic selling, like there normally is? That's what could happen. That's why I look at these charts and I go, oh, look at that MACD. Shaking money flow is still going down too. So when you take a look at the different measures, there's conflict, and you have to pick whether to pick a side, long or short, or there's a third way. And what's the third way that we've been employing? What are we holding a lot of because it's such an uncertain time? What do we have more than almost anybody else in the market right now? What are we holding in our accounts? A ton of cash. There are a lot of you that are 30, 40, 50, 60% cash. I know there's a few of you who are like, I like to say fully invested. There's a few of you who are gone like 100% cash. You should never do that. Maybe 100% invested, you better be really on your game anytime. With the Fed tightening, this just looks so potentially bad. I still think my base case is low 3,000s, middle to low 3,000s. When the Fed stays tight, the lower demand, boy, oh boy. Once this goes down a little bit more, people will start to panic. And those traders will use the options. They'll buy puts to create more momentum to the downside. It's a snowball, right? A snowball down a snowy hill. So we get to look at valuations because those are usually pretty instructive. Stock market's still overvalued. Will it get all the way down to here or get undervalued like it did in the financial crisis? I don't know. What we do know is that earnings looking out a few years have pretty much flattened out. Not a lot of earnings growth right now. When there's not a lot of earnings growth, there probably won't be until 2024, 25. And it's going to be split between the new economy stuff and the old economy stuff. This great divergence that I've been hinting at between the low growth, no growth, and shrinking companies that have debt and everybody else. You shouldn't expect the S&P 500 to have a PE of 20, 21, 22, 23 again for a while, especially if the Fed is going to try not to be too supportive of the losers. The zombie hunting is going to begin. It'll probably come and go. The zombies are going to die. Have you watched the movies? They always die. The zombies never win. There's always enough good guys to kill the zombies. It just takes time. You got to find the venom or the formula or the antidote, the silver bullet. And in this case, the silver bullet's going to be that we start using a lot less oil. But between now and then, right? Better part of this decade. We got to get through that period. EVs aren't really going to ramp up until about 2027. I've been talking to you about that since 2020. And every year that goes by, what I said in 2020 is becoming more and more right about EVs and alternative energy. And I think that this year is maybe the last year that you can buy some of these alternative energy investments super cheap, and some of the things related to the alternative energy, like the metals. So the market's not undervalued yet. Probably needed to get down into this area, one standard deviation. There you go, right in here. One standard deviation, anywhere in this range is normal, abnormal, super abnormal. Wow, never saw that before. Never saw that before. That's where we were. That's not normal. That's normal-ish. It's got to get down to around here to be normal-ish. And this isn't abnormal. This isn't even abnormal. This whole range is historically about where valuations belong. We're not anywhere close to that yet. Crestmont has a chart that's based on inflation, real prices, reverts to the mean, being that red line. Look where we are. This itty bitty correction that we've had so far doesn't mean much at all. You can look at it down here. It needs to get down to here. And that's not abnormal either. That's normal. That's normal-ish. So a market can fall a lot, and it can fall fast. So if you're still heavy in large caps, bless your soul, I think you can be in for a lot of pain. And with 100 to 200 companies on the S&P 500 that probably won't rebound, you better be picking your stocks very careful so that you're in the ones that do rebound. And understand that companies like a whole bunch of the REITs that rely on cheap financing, they ain't coming back. They're going to have to make deals with private equity firms someday. The private equity firms are going to extract a lot of pain. Somebody says, so trim even mega caps like Apple, Microsoft, Google. Where were you the last 6 months? Told you to trim those stocks 100 times. Might be a little bit late if you're not going to have a plan to buy them back that doesn't rely on, oh my God, how do I feel today? You can hold those, right? Especially if you have embedded gains. There are certain stocks that will come back. Oh, I was looking for an acronym. I want an acronym for the 6 stocks that I wanted to be in our portfolios long term. And I found it. Got to change the A in alphabet to G. And I came up with man-bag. What's man-bag? Who can come up with what man-bag is? 3 of them are the ones David just mentioned here in the chat. Microsoft, Apple, NVIDIA, Berkshire, Amazon, Google. Man-bag. Now, if you want to be real funny about it, be very political, kind of, broken nose type, call it Bagman too. You call it Bagman if you wanted to. Probably makes sense going into the elections. I'm going to call it man bag. I'm going to actually put that into an article. It's going to be in the title. Buy a man bag on the correction. Those 6 stocks. Those are 6 of the 10 biggest stocks on the market. And you can buy and hold those. And then you just live with the volatility, because 2-3 years out, you probably get all your money back. And if you have big gains and taxable accounts, right? I can't tell you how to trade because I don't know who you are. What fund, what ETF have I told you I never, ever, ever want to own? The S&P 500. I don't want the whole thing. Well, I'll cherry pick it. So somebody says, Kirk, can you explain if the mega caps and SPY are going to sell off, how would the small caps still thrive in that carnage? What is in most retirement plans? Do they own much in the way of small caps? No. They generally own large caps. People build their asset allocations ridiculously badly. They put 70, 80, 90, 100% of their money into the S&P 500 and the mega caps. Oh, let's see. I own a large cap value, a large cap growth, and a large cap blend. I'm diversified. Bullshit. You're paying extra to be an S&P 500 investor, right? If you own managed large cap mutual funds that overlap, and you take a look and you own 600 stocks, you're basically just buying the S&P 500, but you're paying extra to do it. It's the worst of all worlds. Reason why large cap managed mutual funds don't beat the S&P 500 is because of the added expenses. And large cap markets are more efficient. More efficient means that they move in the same directions at the same time, it's about the same magnitude. Small caps and mid caps are less efficient. What does that mean? That means that they don't move in the same directions and same magnitudes over and over again. They're less correlated. Correlation is something you better understand. Look it up, Google it, live it, love it, learn it. Large cap markets are efficient. When they go up, they pretty much all go up. When they go down, they pretty much all go down in about the same amount, give or take. Small caps aren't like that. IWM, Russell 2000, is down quite a bit more than the S&P 500 over the last several years. Has trailed. Long term, that's not the case. Long term, the Russell wins. However, because of the failures versus the ones that go up 1,000%, owning the index is kind of dumb. I don't know why anybody would ever own IWM except unless you're trading it with options or trading it somehow. It's not something you buy and you hold. If 20% of the stocks in IWM are going to account for all the gains, look for those 20% of the stocks. And what I just said is true. About 20% of the stocks in IWM account for 100% of the gains. So look for those. Break it apart into pieces in your head by market cap, by the types of companies that they are. What sorts of total addressable markets are these companies addressing? Do they have competition? Do they have a moat? I'll go back to the satellite stocks because I'm just telling you, we're going to make a lot of money in those satellite stocks. We need those satellites up in the air. They have a gigantic addressable market. And at some point, the government says that's enough satellites in the air. They'll start running into each other. Or they're just going to get bribed, right? Politicians will just get bribed. And the half a dozen or dozen or whatever number of companies that's going to be that's up there telling us everything that's going on in the universe. I'm going to bribe the politicians and say, hey, if you put more satellites up there, something bad's going to happen. Oh, here's your cash, right? Follow the money. Big tech got away becoming big tech, very monopolistic, because they peddled the lie that it was all good for everybody, that killing the competition was okay. And by the way, have you checked your campaign fund lately? The only reason that there's been pushback on big tech is because Europe couldn't be bought. That's it. The Europeans are forcing competition, and the Democrats do too. I mean, this administration has anyway. And pushing competition is very good for small companies because they're more nimble. They're just as smart in this horizontal economy that we're seeing where you can buy the services that you need. Think of Ginkgo Bioworks. They're creating a horizontal biotech framework that doesn't require you to have billions of dollars to do the research. They're sharing the platform and the data. You take your problem and say, this is what I'm trying to solve. You buy some time, right? You write your check, and then you give them some equity in case your thing makes a bunch of money. That's why I really like Ginkgo Bioworks, because some of the companies that are using their platform and data are going to solve really big problems and make a lot of money. And Ginkgo Bioworks gets a cut of that. They could literally be getting paid royalties from hundreds of companies 10 years from now. They're already about a dozen companies in. Same thing with Palantir. Palantir is going to be getting revenue from over a dozen companies, Black Sky being one of them. They might even absorb Black Sky. Since 2021, this whole area up here above the orange line, I've been telling you that you need to trim your large cap holdings. But they just went up. Yeah, sell them. And you might get a little rally to do it into. But this little rally that I talked about for the last month sure didn't amount to much. All it was jitterbugging. So unless the equity markets, for the first time in the history of markets, can fight off the Federal Reserve, there's more correction coming. And the thing that could happen is there's a little fake out, then it resumes to the downside. But the fake out should have been ahead of the tightening. It should have been now in the last few weeks. And all we got is some days here and there. And Jeremy Grantham is a pretty smart guy. I hope he's wrong this time. All right, Freeport-McMoRan. You've heard me say respect the cycles of the stock market. I've invested in this company 4 times in my career. I invested here, 2002. I invested here, and I actually bought this in March of 2009. That was my best one. I bought it in 2016 and didn't make as much because I was selling it in 2017. I don't think I caught quite this whole rally there. I sold it more in here. And I bought it down here on the financial crisis, or on the COVID crash. And I sold it right around 20, which turns out to have been stupid. Now, will I get it all the way back down close to 20? Might. The Federal Reserve might give me that chance. So one of the stocks that we're going to target, if we get the opportunity, is Freeport-McMoRan. If the next year or two, Freeport-McMoRan gets down around 20, we're going to want to buy it. Here's why. Because going into the EV and clean energy age, we're like in batting practice on that now, right? Game hasn't even started. We're still in batting practice on that stuff. The need for these metals is going to go up higher than it's ever been. Iron, because a lot of the batteries are going to be able to use iron. Copper, obvious reasons. These industrial metals are going to become maybe more valuable than they've ever been. And the companies that mine them will go through these big cyclical peaks and valleys. And it's going to take 10 to 15 years to get enough mines online for there to be excess supply. So Freeport-McMoRan should do very well, just like it does in every cycle. I mean, you've never seen anything this cyclical, right? So if we get a correction, then you might get your commodity boom there through end of decade, early next decade, because all that metals have to do is on a relative basis be cheaper than oil, right? Should be able to pull that off for a while. That won't change until there's panic pumping in oil, which probably isn't for a few more years. And remember, nothing's instant. It takes years for the effects to be felt. It's usually a 2-year to 4-year time lag. So if we can get Freeport McMoran down here, kind of where I sold it, probably want to buy it. Now, again, if the Fed is super tight, there's some reason that this goes way down here again, and we get the Armageddon zombie apocalypse, then we buy a ton of it. So as it comes down, we're going to have to evaluate where we are. Are we going to keep going down or not? So people ask for price targets. Price targets are dumb. It's just like model portfolios are dumb. I know that everybody wants symmetry and rules. The rule is you make an estimate of where you think it should hold. And when it gets there, you evaluate, is it going to keep going? Has that knife hit the floor yet, or is it still falling? And the reason that's required is because you should beware geeks with formulas. The quant ratings on Seek and Alpha are obnoxiously bad. They're too short-term in nature. They don't consider the longer cycles. All they need to use is the volume studies. The volume studies tell you where the rich people want to invest. The rich people are rich. Why? Because they actually believe in buy low, sell high. Believe in buy low and sell high. Believe that. If you believe in that, if you make that your money religion, you'll do so much better. PBW, which is going to use some of those metals. I'm debating where this belongs because this was an area that got some buying. But if you drag this down to 2018, which is probably the relevant time frame, it starts to get a lot of exhaustion from sellers in the 40s, right? You had all these people buying on the way up, now selling on the way down. And somewhere in here, you're just going to run out of sellers. We're running into some pretty strong hands on the alternative energy stocks. I think that's why it's jitterbugged a little bit here. So I think maybe one more leg down to the low 40s, then you're going to want to own PBW because this roster of stocks is pretty strong. People want to say, well, the alternative energy companies aren't profitable yet. Yeah, they are. Yeah, get all the old narratives. Doesn't mean it can't go down here during the zombie apocalypse. It can. But this is more likely. This is possible. This is more likely. So go back and look at the second quarter plug and play stocks. Then go to the VSL and see where some of the new bottom fishing are. This is 90% going to be a repeat in Q3. Only going to change about 10 stocks out of 60 or whatever it was. All right, I answered a couple questions along the way. It's been an hour. Don't panic if you haven't already done what you need to, but understand that the pain is going to start hitting the top stocks now, the big stocks. Correction you've seen so far has been minor. It's been orderly. Hasn't been that painful yet. We'll talk about individual stocks on Monday. All right. Have a good night. I'm going to go have strawberry rhubarb pie. You know why? Because today is dark and stormy day. It is also strawberry rhubarb pie day. If you ever go to one of those things that tell you what day it is, where are the holidays today, take a look and then go grab your girlfriend or boyfriend because there's something else that it is today too. So get it all in. I'm starting with a drink and then a piece of pie. Then I'm going to do that other thing that they say it's the day of. All right, everybody have a fantastic night. And remember, we have a plan for that.